So going over this chapter, current liabilities and contingencies, what is this chapter really about? We are going over essentially what must be accrued as a liability for each type of liability. We're going to go over whether it's deferred revenue, whether it's legal regarding a lawsuit, whether it's payroll. I see that payroll is very much emphasized right now on this part from this section on the CPA exam from looking at the questions. And, basically your job is to see all the transactions that might trigger a liability and apply US GAAP in order to realize, do I accrue? The first question is, do I make the entry? Do I make the accrual? Right, which is going to be credit liability, debit some kind of an expense, usually is the entry. And the other question is, how much do I accrue for? So that's what we talk about. We have current liabilities, where we're looking to pay somebody, we're looking to pay accounts payable, notes payable, commercial paper, dividends, accrued liabilities, income tax liability, or legal liability. So that is what basically happens when does an account payable trigger? This is obviously a short-term thing, and this happens you have to determine the existence and recording in the appropriate accounting period. So we need to use the matching principle to figure out, hey, what period is this going to be in? And that means you have to match the expense to which that expense helped get revenue in the timing period. Usually it just goes by month, right? That sometimes there are timing differences, okay? Current liabilities, we're looking, for example, this is the current liabilities for General Mills, and you can see that it starts with accounts payable, and then we have long-term debt, note payable, and other current liabilities. And let's see here, this is further than we have note payable and then what we owe financial institutions. So this could be with more detail around the loans as well. So which of the following statements is true about current liabilities? Current liabilities are obligations payable within 1 year within the firm's operating cycle, whichever is longer, usually 1 year. Current liabilities are ordinarily recorded at maturity amounts rather than present value, right? The actual amounts, not present value. Current liabilities is those expected to be satisfied with current assets or by creation of other current liabilities. So the answer is D. Looking at short-term notes payable, any kind of loan, a note, essentially credit lines, secured loans, unsecured loans, commercial paper, and this is coming in as a loan and then will be paid back pretty much on a short-term basis. And what the disclosure of credit lines is the terms. How much was available on the credit line, how much is, what is the maturity of it, how long does it exist, what's the max outstanding, and the interest rate. So that's basically what you would look at in terms of disclosure. But how much do you actually compute as interest in terms of payable? So let's look at an example. On May 1st, Affiliated Technologies, a consumer electronics firm, borrowed $700,000 cash from First Bancorp under a non-committed short-term line of credit arrangement and issued a 6-month 12% promissory note. Interest was payable at maturity. So if you look here on May 1st, this is when the note was issued. So they got cash May 1st, debit cash, credit note payable. Now you have the liability. Okay, they received the cash, right? They raised funds. That was a financial decision to raise funds. And now they have to pay it back. And they have a 6-month note. So what happens after 6 months? After 6 months, okay, they're assuming there was a 12% note. What happens was, first of all, we have to record an interest expense. So we have the formula here from the prior slide. Face amount, $700,000, times the annual rate, which is 12%, times half, right? So that would all equal out to $42,000. And that would be interest expense. How much do they pay? They pay back the note, and the interest expense gets recorded. They pay it all in cash, and they debit the liability disappears, and the interest expense goes into the expense account. So this is an example of what that would look like. And let's see, we'll do one more. And Mayfirst Philly Technology is a consumer electronics firm, borrowed $700,000 in cash from the bank, and then they have a non-interest bearing note with a 12% discount. So this situation, they got cash up front, $658, because that was basically how much they would receive, as a discount, right? And then discount on notes payable is recorded because they received at a discount, and their liability is $700,000. And then what happens when they pay it back? They record the expense, get rid of the discount on notes payable, and get rid of the notes payable and credit cash. So this is an example of both ways. Obviously, usually it's done this way. This is more like the amortized and premium method that we discussed in the last chapter.